If you are still buying crypto based on price alone, you are already losing. Let me show you what really matters.
If you have ever said, this coin is only $0.01, if it reaches $1 I will be rich, then you need to pay very close attention to this message. Today we are going deeper. We are going to fully understand why market cap is far more important than price when you are considering buying any cryptocurrency. This is not just beginner knowledge. This is foundational investment thinking. If you truly understand this concept, you will stop chasing hype and start making calculated decisions. Let us break it down step by step. Most beginners enter crypto with the wrong mindset. They look at price first. They scroll through coin listings and immediately feel attracted to coins that cost less than $1. The logic sounds simple. If I can buy thousands of coins for a small amount of money, then when the price increases I will make more profit. It feels psychologically satisfying to own 10,000 coins instead of 0.002 of a coin. But that feeling is emotional, not logical. Price by itself tells you almost nothing about value. It is simply the cost per unit. To understand why this thinking is dangerous, imagine two different companies. Company A has 10 shares in existence and each share costs $100. Company B has 1 million shares and each share costs $1. If you only look at price, you might think Company A is more expensive. But if you calculate the total value of each company, you will realize they are both worth $1,000. This total value is what we call market capitalization. In crypto, market cap is calculated by multiplying the current price by the circulating supply. That is the formula. Price multiplied by supply equals market cap. Market cap represents the total value of all coins currently in circulation. It shows how big the project actually is in financial terms. Now let us apply this to crypto. Imagine coin alpha costs $0.01 and has 1 trillion tokens in circulation. Multiply 0.01 by 1 trillion and you get $10 billion. That means this project is already valued at $10 billion. Now imagine coin beta costs $1,000 per coin but only has 10,000 coins in circulation. Multiply 1,000 by 10,000 and you get $10 million. Even though coin beta looks expensive because of its high price per coin, its entire market cap is only $10 million. That means coin alpha is 1,000 times larger in valuation than coin beta, even though it looks cheap. This is where most people get confused. They see a low price and automatically assume there is more room to grow. But growth in price is directly connected to growth in market cap. If a coin already has a large market cap, it requires massive amounts of new money to significantly increase in value. Let us go deeper into the mathematics of growth. Suppose you want a coin to do 10 times from your entry. If the coin has a $10 million market cap, it needs to grow to $100 million for you to achieve that 10 times return. That means $90 million of additional capital needs to flow into that project. That is challenging but possible. Now compare that to a coin that already has a $10 billion market cap. For that coin to do 10 times, it must reach $100 billion. That requires $90 billion of additional capital. That is an enormous amount of money. This is why market cap determines how realistic your expectations should be. Now let us talk about the most common trap in crypto investing. The if it reaches $1 mentality. People see a coin trading at $0.001 and immediately calculate potential profit if it hits $1. They multiply their bag by $1 and start dreaming about millions. But they skip one critical step. They forget to calculate what the market cap would be at $1. If that coin has 500 billion tokens in supply, then at $1 the market cap would be $500 billion. You must then ask yourself, is it realistic for this project to become worth $500 billion? That would place it among the largest financial assets in the world. Does it have the adoption, technology, network effect, and institutional support to justify that valuation? Most of the time, the honest answer is no. Market cap forces you to confront reality. It removes fantasy projections and replaces them with measurable expectations. Another important reason market cap matters more than price is liquidity and stability. Large market cap coins like Bitcoin and Ethereum require enormous capital inflows to move significantly. This makes them more stable and less volatile compared to small cap coins. Small cap coins, on the other hand, can move very quickly because their total valuation is low. A few $1 million entering or leaving the project can dramatically change the price. This creates opportunity, but it also increases risk. A coin with a small market cap can double quickly, but it can also crash just as fast. Understanding market cap helps you match your risk tolerance with your investment strategy. If you prefer stability and long-term growth, you may focus on large caps. If you are comfortable with higher risk for potentially higher reward, you may explore smaller caps. But in both cases, your decision should be based on market cap, not price per coin. Let us also address token supply psychology. Many projects intentionally create very large supplies because it allows them to price the coin very low. A price of 0.001 feels cheap. It attracts beginners. But that low price is often a psychological strategy. If a project has 1 quadrillion tokens, even a small price increase represents a massive increase in valuation. Without checking supply, you cannot evaluate realism. Think about it this way. Owning 10,000 units of something does not make it more valuable than owning 0.1 of something else. Value is determined by total network worth, not how many pieces you personally hold. The stock market operates the same way. A company can split its shares and reduce the price per share, but the overall market cap remains the same. Nothing fundamental changes. The same principle applies to crypto. Let us look at historical perspective. When Bitcoin was worth $1 billion in market cap, it had massive growth potential because the entire crypto market was still small. As Bitcoin grew into the hundreds of billions, the percentage gains naturally slowed down because the base became much larger. This does not mean it cannot grow further, but it means each doubling requires significantly more capital than before. That is the law of large numbers. The bigger something becomes, the harder it is to multiply rapidly. This is pure mathematics, not emotion. Now here is the smart investor mindset. Instead of asking can this coin reach $1, ask what market cap would that price represent. Then compare that projected market cap to existing projects. Is it higher than Ethereum? Is it higher than the entire decentralized finance sector? Is it higher than global payment networks? If your projected valuation exceeds realistic benchmarks, your expectation may need adjustment. Always anchor your predictions to market cap reality. Another critical factor is circulating supply versus maximum supply. Some coins have tokens that are not yet released into circulation. If large amounts of tokens are scheduled to unlock in the future, the circulating supply will increase. When supply increases, maintaining the same price requires additional capital inflow. If demand does not grow proportionally, price can struggle. Market cap analysis combined with supply schedule analysis gives you a much clearer picture than price alone ever could. Let us summarize everything clearly. Price is the cost per coin. Supply is the number of coins available. Market cap is the total value of the project. Growth in price requires growth in market cap. The larger the market cap, the more money is required for significant price movement. Low price does not mean undervalued. High price does not mean overvalued. Market cap is the metric that reveals true scale, realistic growth potential, and risk level. If you discipline yourself to check market cap before buying any coin, you immediately separate yourself from emotional investors. You begin thinking in terms of valuation, capital flow, and probability. That shift in thinking can protect your capital and improve your long-term results. In crypto, knowledge is not optional. It is protection. And understanding why market cap matters more than price is one of the most powerful protections you can have as an investor.